Today, I'm going to talk to you about selecting an ESG investment benchmark. So a benchmark is a standardized tool that can be used as a point of reference. In that respect, it's got to be a reference point for a sponsor's portfolio. But it's also used as a communication tool. In other words, it gives instructions to the fund manager. At the same time, it gives instructions from, for example, a board of directors or an oversight group. Identification and evaluation of the current portfolio is facilitated by a benchmark. At the same time, this allows you to attribute, thereby interpret past performance. Because of that, it allows for manager selection and appraisal and the marketing of investment products. And obviously, you can also use it to demonstrate compliance. And that's particularly relevant to ESG, because with ESG, you set parameters. And those parameters are something which obviously you want to ensure compliance with. So let's look at the definition of an index. So according to the Stevenson Oxford English Dictionary, an index is a figure in a system or scale representing the average value of specified prices, shares, or other items as compared with some reference figure. So it doesn't just stop there, because that index has to have desirable benchmark properties. It's got to be unambiguous. So in that respect, it's got to have clearly identifiable parameters. So from an ESG index perspective, this is really important, because obviously your social norms that you want incorporated in your investment process have to be unambiguous. It also has to be investable. And in that respect, it's got to be replicable. So if you want, for example, to pursue a passive ESG strategy, what you need to do is make it investable. And therefore, it has to be something which the rules can be repeated. I talked about attribution. It has to be measurable. In other words, the return has to be calculated on a frequent and a regular basis. The index also has to be appropriate. And again, this comes back to ESG, because with ESG, you clearly want to have an appropriate index. You don't want to use a broad index, for example, the FTSE 100 or the Standard & Poor's 500, because some of those companies in that index aren't associated with what you consider to be best practice in ESG. Likewise, you want it to be reflective of current investment opinion. Now, once again, this is important for ESG, where there are a large range of investment opinions as to what is right or wrong from an ESG perspective. Weapons, for example, could be included in one set of criteria, or for a defensive purpose, it is excluded. Likewise, alcohol in some ESG portfolios is strictly prohibited, particularly in, for example, Sharia ESG portfolios, but however, in other more liberal ESG interpretations might be included. They have to be specified in advance. You can't change the goalpost after you've set it. And also, they have to be accountable. In other words, the manager has to take ownership of that benchmark and report against it. Now, I've mentioned indices, but when talking about benchmarks, there is a whole raft of different sorts of benchmarks that can be applied. So in this respect, there's some academic research by Bailey, Richards and Tierney that was produced in 2007, which differentiates the benchmark types. They focus on absolute and target return benchmarks as the first sort. And obviously, in that respect, if you're running an ESG portfolio and you have an absolute benchmark, that's quite clear cut. You just have to return, for example, positive performance or target rate 1% better than inflation. Manager universes or peer group benchmarks are the sort of benchmarks that are very clearly delineated from the people who follow the same approach as you. So in that respect, with ESG, it's quite clear you have a group of people who have the same norms. Now, obviously, that means that those exclusions should be the same for the peer group. And obviously, that's not always the case. I mentioned, for example, Sharia, which is a form of ESG. They prohibit interest in Sharia portfolios. Obviously, that is not something which a traditional Western ESG portfolio would prohibit. They also defined broad market indices like the FTSE 100 or the Standard & Poor's 500, the national indices that in a mark of its mean variance portfolio approach would really be what we call the tangent portfolio, the market proxy. Now, this is still relevant to ESG investors because obviously you're making a choice to invest away from that. And therefore, that is still a relevant benchmark from the point of view of attribution of your decision to take an ESG approach. There are also style indices, and in that respect, these are determined by whether you're growth or value and so forth. There's a slight correlation between different types of styles and ESG, very much old industry, value-based industries tend to be a little bit more destructive to the planet, for example. However, these are typically not used in an ESG context other than to tilt an ESG custom index. There are factor model-based benchmarks. So, for example, Farmer and French, who look at different factor styles. In fact, there are 256 different types of factor styles, from economic factor styles to financial factor styles, ratio factor styles, and so forth, counting ratios. You can, of course, make an ESG factor. You just need to do a regression of some various ESG empirical metrics against your return time series to get an idea of where you lie on a factor model-based approach. So you can have a custom factor model-based. You can, of course, just focus purely on the sort of mean variance efficiency of your portfolio and do some sort of sharp ratio benchmark where you're trying to optimize your sharp ratio. And obviously, you'd have to look at the literature on that to understand what that is. But effectively, what that means is that your risk-reward ratio is optimized. And finally, they proposed custom benchmarks, which really what quite a lot of ESG approaches do. In other words, you specify exactly what you want. So if you have a non-standard ESG approach, such as you don't want to invest in property companies that desecrate churches, by example, rebuilding them and repurposing them for residential, then obviously you need a custom approach to do that. So as you can see, there's already, just in the selection of benchmark, a whole raft of different choices. And those different choices obviously mean that you have to make decisions on what sort of benchmark approach, but it also affects the way you screen your universe. Now, quite a lot of what I've been talking about is negative screening. In other words, you take the universe of investments and you take something away from it. In other words, you exclude, for example, tobacco from your universe, and that's called negative screening. There are some ESG providers that do positive screening. In other words, actively adding those companies that are positively either carbon neutral or potentially helping the environment or social goals and so forth. You can just tilt a portfolio. We talked about broad market indices. You can just say, well, actually, I'll take the FTSE 100 as my benchmark and tilt it towards companies that are doing good and so forth. And this is, for example, the FTSE for Good approach. You can focus on best in class. This is a quantitative approach. There are a lot of non-NGOs that are focusing on creating best-in-class ratings, and you can use a rating approach or ranking approach to select portfolios in your screening approach. There are ESG integration approaches as well, and there's also stakeholder engagements where you effectively accept that companies are out there doing business, obviously not with a social goal, but with a profit motivated goal, but that can still interact and push forward a stakeholder agenda by, for example, writing to companies and saying, look, we don't quite appreciate you using labor or child labor in certain countries, for example. So there's a whole raft, obviously, as you can see, of indices. Let's just drill down into one of them, the MSCI ESG indices. They have a whole range of different approaches. They have a low carbon index, they have a universal index, a universal ESG index, that is, they have an ESG leaders index, they have a focus index, they have a fossil fuel and faith-based index, and an environmental and women leadership index. So as you can see, depending upon your ESG focus, you can get quite a tailored custom index, even using a traditional provider. There are a few pitfalls you have to watch out for. For example, if there are turnover limits, for example, you're not allowed to invest in the military if turnover is greater than 5%. Well, actually, General Electric, one of the world's largest companies, has military turnover in terms of its sales, but actually it's at about 4.8, 4.9% of sales. So actually is included in some indices, even though ESG indices, even though those indices exclude companies with more than 5% of turnover. So it's just something to watch out for. So in conclusion, benchmark choice matters. It matters for ESG. You need a sustainable benchmark that reflects effectively what your ESG criteria are that you have adopted, and you need your manager to align himself to that approach. Effectively, you need to set your criteria, and if you can't do that with existing indices, you need to create a custom benchmark. So there you have it. The benchmark is the beginning and the end of the investment process, and whether you take an ESG approach to investment or not, they're still just as relevant. Thank you.